Hello class, in this revision video we'll be talking about central bank, that is the Reserve Bank of India. I have already taken up this video in class and this is a revision lecture for you all. All those who have already attended those classes in which I have taught Central Bank and Reserve Bank of India, it would be a revision video for them, and it would be even beneficial for all those students who were absent in the class when I taught these topics, because now you can cover these topics from here. You can also go through the notes which I have shared, and you can also study from your internet or book sources. I have already mentioned in my past few lectures. But if you find any difficulty in understanding anything from my source or from your source, kindly get back to me. I'll be more than happy to help you all out. So let us start. Evolution and role and function of Reserve Bank of India. Here it would be and, not of. Evolution and role and functions of Reserve Bank of India. Now, Reserve Bank of India started from Reserve Bank of India Act 1934, and its inception was in 1935. It started with a capital of 5 crore rupees, and Reserve Bank of India started in 1935 working as the Central Bank of India. And in 1949, this bank got nationalized. What are the key initiatives of Reserve Bank of India? Restructuring bank inspection, fortifying the role of statutory authority or statutory auditors in the banking system. Basically, the key initiative with which it came was to restructure all types of banking account auditing inspections, so that banks can be more accountable to the general public and more responsive to the money of the general public, needs of the general public, and that so that transparency should come in their working. Now, role and function of RBI have been very critical after independence. You all already know that when we got independence, we were really shattered and poor. So RBI worked really hard in strengthening the economic structure, economy of the country. Until now also it is having a very important role in the economy, and we'll study that role by seeing that what functions the RBI is doing. The important function which the RBI is doing is issue of currency notes. Obviously they issue currency notes to the for the country, all the currency note which we have except for 1 rupee note, which is passed by the finance department of the government of India. Bank of the government, it is the bank of the government, gives loans to the government, it manages the accounts of the government. Banks of the banks, it manages all the reserves, cash reserve ratio and all such ratios of the banks, also all the reserves which bank keep with RBI. Banking system regulator, all the regulations which RBI passes time to time, that those regulation only regulate the banking system of the country. Clearinghouse function. Clearinghouse function means that when there are many checks between two banks, that they, for example, some of the people who have their account in ICICI Bank have given the checks for encashment to the people who have their account in SBI, and vice versa. Now both the banks have claim of checks against each other. Now what they'll do when there is lot of such claims, then RBI work as a clearinghouse agent between two banks and help them to clear all the claims of checks or any kind of negotiable instrument which they have against each other. It works as a clearinghouse agent between two banks. Credit control. Now, this function of credit control, which is done by RBI, is in the form of two main ratios, which is set up by RBI, that is SLR and CRR. Statutory liquidity ratio (SLR) and cash reserve ratio (CRR). Now, statutory liquidity ratio means some amount of liquid cash which the banks have to keep with themselves, so that they can meet up with the day-to-day functioning of the bank, and so that they can give or honor all the money which, so that they can honor all the demands of all the depositors which have deposited their money with them, and they can also give loans. So if the SLR is more, then that means there is more money in the hand of the bank, so that they can give more loan. So SLR can be reduced to increase the to decrease the cash flow, to decrease the rise in the prices of all the commodities, basically to decrease the loan. Because when loan is given to the people, then people get power to buy things. They become prospective consumers, customers. So by increasing the statutory liquidity ratio, what are they doing? They are giving more power to the banks. The RBI is giving more power to the bank to give loans to the people. So if they are decreasing the statutory liquidity ratio, that means they are giving, RBI is giving less money to the commercial banks in their hand to give loans. That means less money is floated in the economy. Now coming to cash reserve ratio. Cash reserve ratio is the ratio which a certain amount of money with which every bank has to keep with RBI. Some percentage of their reserve have to be kept by with RBI. Now that money, that I have also taught you in Banking Regulation Act. Now that money which the commercial banks have to keep with RBI, that money, if the ratio is increased, that means more money has to be kept with banks. So the banks, RBI, so the banks would be left with less cash, so they'll be able to give less loan. So less loan means less money in the hands of the people, so less consumption. If RBI wants that there's a lot of deflation in the society, and if RBI want inflation in the society, then RBI would decrease the CRR, give more. That means now banks, if the CRR is decreased, that means the bank have to keep less amount of money with the RBI. Then they have more money in hand with them, so they'll give more loan to the people, and then people would be able to consume goods, and economy would move towards inflation. And if there's inflation in the economy and you want to lower down the flow, RBI wants to lower down the flow of the money, then RBI can take up money from the bank in the form of CRR, SLR, and then in the form of CRR, and then banks would be left with less cash, and they'll be not they will not be able to give cash to the people in the form of loan. So this is how credit control is done by RBI. Lender of last resort, obviously RBI is the lender, loan giver to all the banks, advisor to the government. RBI advises government, being the Central Bank of India, on important economic issue, and controller of foreign exchange. It controls all the foreign exchange which is there in our country. Now, organization structure. You can kindly and easily see the organization structure. The top-notch employee of RBI is governor, then deputy governors, then executive governors, then principal chief general managers, then chief general managers, then deputy general managers, then assistant general managers, then assistant managers, then support staff. This hierarchy is going from top to down. Okay, so you have to learn this hierarchy. It is nothing like very difficult, and I can't explain anything in this hierarchy because this hierarchy has to be learned by heart. I hope the fundamentals of RBI and central bank is clear to you all. The most important topic is functions only in this regard, and if you find any other difficulty, you can get back to me. Thank you, class.